All right. Good morning, everyone. VA Friyay. Hope you guys have a great weekend. It's going to be hot as balls in Washington. So we're going to be talking about like the difference between what are the ways that a client can affect their mortgage payment outside of the down payment, which is kind of a big thing for a lot of clients who have the cash to bring down for a down payment and want to improve their payment as well as to get their offers accepted, right? So before we get started, got to start off with the dad joke, right? So what part of the museum makes you sneeze the most? Statues. Okay. So one of the things I want to show you is something called a rate sheet. So let me blow that up a little bit better. So what a rate sheet is basically tells us all the rates available for that specific client at that specific time in the market. Okay. So a lot of them believe that a lot like auto loans, you just get one interest rate and that's it for the rest of the loan. That's it. And you don't get to choose. With mortgage, it's completely different, right? You have options. You can buy down your rate. You can go up on your rate to get credit. I have a lot of clients that are doing that right now to get closing costs paid for. So even when we lock their interest rate, we can still change it, because what we did when we locked their interest rate, we're keeping it from changing it with the market. So when we look at the rate sheet, we see the rates from, the lowest to the highest. As you notice, the higher you go up in the rate, the cheaper the interest rate goes, right? So this is the cost of the rate based on the loan amount. And what actually changes with the market is the cost of that interest rate, okay? So as you go up on the interest rate, you notice the cost of the interest rate goes down based on that dollar amount until it hits an inflection point where it becomes a negative number. I have a lot of clients right now in the last really since the start of this year, who don't have all of their closing costs or just have enough for closing costs, that decided to go up on their rate and get this negative number that gets credited toward their closing cost. And that's a great strategy that we've utilized so that clients didn't either have to spend all this money toward closing costs, spend a little bit less, or get the credits that they need to buy the house. And then what we can do later, after 9 or 10 months, we can refinance them for a better rate. Now, the purpose of the discussion is really talking about what makes more sense, down payment or rate buy down. Okay. So, like I said, even after we lock the interest rate, we can still change it up and down as we need to. So we're going to compare a $350,000 house. Now, the rates I just showed you have nothing to do with today. So please don't take that to what rates are right now. These are what rates were literally more than a year ago. I just want to give you guys an example on how much it can change. So for a $350,000 house, the cheapest interest rate we have on this specific chart is 3.75. Okay. So what we want to compare is, what if we bought the rate down as low as we could, which is 2.875 in this case, right? So at 2.875, it costs about $9,600, right? So, and that dropped the payment down by $169. Okay. Now let's compare what it takes of a down payment to bring it down. Okay. So if I bring in $20,000 as a down payment, it only brings it down by almost $93. Okay. You guys notice that the payment here is that comparison, $100 here, 2.875 to this here is about $169. Okay, there's all these numbers green are the difference between scenario one. So let's say we bring in another $30,000, another $10,000. Okay, so getting a little closer, $40,000. So just over, so about $35,000 to about match what it would take to spend only about $10,000 to bring the payment down to about the same. So as you notice, $35,000 versus $10,000, that's 3 times less to just buy the rate down and be more effective. So in this case, for closing costs for a $350,000 house, depending on the state, this is $42,000 and this is $16,000, literally 3 times less. So if a client is very specific about wanting to bring down their mortgage payment, I always prioritize buying down interest rate first, and then they can bring down the down payment. Maybe they have $50,000 down and they want to bring it in, then they could totally put in $34,000 here, and that would save them another almost double that. So that's just one of the things I want to show you guys in regards to what it makes sense and how to guide your clients in the direction that makes the most sense, and making sure every dollar they spend toward the house is the most bang for their buck. Also, buying down the interest rate will also reduce how much interest they're paying through the life of the loan, and also increase how fast they pay down their principal. Okay, so if you guys didn't know, inside your mortgage payment, there's principal and then there's interest. The lower your interest rate, the smaller the interest portion gets, and the bigger the principal portion gets. So, sorry, the interest portion gets smaller, principal portion gets bigger. Therefore, the principal pay down is a lot faster. So after a couple of years, they probably would have been ahead on paying down their loan balance than they would have if they had got at a higher rate. Now, this only applies to clients that really have that cash to put it toward the house. For those clients that don't have that cash, generally I recommend just either keeping the rate as low as, or keeping the rate as cheap as you can, or even go up on the rate to reduce how much cash you're putting into the house. And then at a later time when rates get better, or when their credit or whatever caused their rate to be a little bit higher, refinance, and then there's no money out of pocket. So depending on that also could be a potential opportunity to be able to make sure we're looking out for the client financially and making sure it all fits with their financial plan. Otherwise, that's all I got for you guys. Nuke out.